presenter tonight is Lynn Irving. She is a CPA with over 40 years of accounting and auditing experience working with clients in a variety of industries, including manufacturing, oil and gas, financial services, employee benefit plans, construction, governmental, and not-for-profit. She has designed and taught audit staff training courses for local CPA firms. Lynn has taught at the college level for 34 years, specializing in financial accounting and audit. She has also taught continuing professional education courses for the American Institute of Certified Public Accountants and the Texas Society of Certified Public Accountants, and served as the National Auditing Instructor for Kaplan's CPA Review. So we're so happy to have you this evening.
Thank you. So you can't ask me any tax questions. That's what basically my background is. I do everything but tax. And I hope that's not, I didn't want that to come across in a negative way, but I want you to understand that that's a harsh reality. I have been around so many businesses that fail because they have not managed their cash flows. And my analogy is cash flow is like the blood in your body, right? You can lose an arm or a leg and you can still go on, but if you bleed out, you can't, you're done. So it's just so important. So that's what we know, right? Cash is king. There it is. Okay, so I have a question right off the bat here. What is the number one reason that small businesses fail? Yay, okay. Oops. There we go. Question 2. Now do you know this one? What? C? Anybody else? D. Yeah, it's kind of high, right? That's a high. When I was first doing my research on this, I thought, oh, it can't be that high, but it is. All right. So there's some words of wisdom out here, and the first one, what you measure, you can manage. Everything else is guesswork. I consider that to be the most important one, and that came from somebody that I did a course with at TWU. It was a gentleman who was in the industrial laundry business. I didn't even know what that was, but that's the folks who launder these tablecloths and maybe hospital linens and Jiffy Lube uniforms and things like that. And he started out up in Pennsylvania, and he emptied waste baskets. And he rose up through the organization and got to the point that he owned 3 laundries. And he opened every one of his presentations with that. He would have his plant managers, every Monday they had to have on his desk an Excel spreadsheet that had certain statistics on it, like how many pounds of laundry did you wash this week? How many gallons of water did it take to wash that many pounds? How many kilowatts of electricity? And he had this real interesting thing happen. One Monday morning, the water usage just spiked. It didn't make any sense. And guess what? There was a leak, right? 3 weeks before they would have gotten their water bill. And so he was able to get on top of that right away, and that always kind of stuck with me. So the numbers are important. I know they're boring, but they don't lie, okay? You can't hide behind the numbers. So all those are just, words of wisdom. Okay, so why do we need to understand the cash flows? Well, you got to keep the cash flows positive. Once they start going negative, that's when you're in the danger zone, because then you're juggling. You might not be able to pay yourself, right? I'm sure some of you, there's been times that you go, oh, I got to pay this bill first. I'll wait a couple weeks and then I'll take my money. Yeah. So the positive cash flows allow you, you can expand your operations. There's a lot of investment opportunities. I've worked with a lot of clients and they want to expand and they go to the bank, and the bank is doing a diagnostic on them almost immediately. They're looking at their balance sheet. Okay, we'll talk briefly about a balance sheet. They're wanting to see evidence of liquidity. We'll talk about liquidity, right? Liquidity means you have more liquid assets like cash and accounts receivable rather than short-term liabilities. So they're always looking, if they're going to give you a loan, they want to see liquidity. They want to see positive cash flows. Okay, we're going to talk about this concept of working capital. So it will allow you to either borrow money or maybe find investors that are willing to go in and help you with your business. Okay, so they're going to be running the numbers on you. Replace worn assets, right? You have to have, we're going to talk about a rainy day fund. It takes a long time to get a rainy day fund, but it needs to be on your radar at some point because there's going to be some things that wear out and you're going to have to replace. And then hopefully you get to pay yourself back with dividends, right? However that, or whoever else is an owner in your business. Okay, so here's the boring part. As far as cash flows go, these are the 3 financial statements that you should have every month, okay, in some format. They don't have to be real sophisticated. Some of you, how many of you use QuickBooks? A lot of people do. I have giant clients that use QuickBooks because it's very powerful. For the cost, it's extremely powerful. And it's pretty intuitive. You got to be careful. The thing about QuickBooks, it doesn't stop you from making mistakes. I've seen like really bad accounting done on QuickBooks. So these are the 3 financial statements that we want. Our balance sheet, we're going to look at one, and an income statement, sometimes called a P&L, profit and loss statement. You'll hear accounting has too many acronyms, okay? Then we just have them coming out every which way, and so you'll hear somebody talk, oh, the P&L, that's profit and loss. Sometimes you'll call it the statement of operations. And when we look at these, the balance sheet only gives you a picture of the business as of one day. So if you're whatever year end, how many of you have December 31st year ends? A lot of you do, right? That's what most people do. Other businesses you can pick any year end that you want. A lot of businesses will change their year end and not have it occur at the busiest time of the year. Because you're so, like retail. If you look at Target, their fiscal year end is sometime in February. Okay, because they wait for all that Christmas stuff to die down and then they're ready to close the books. So sometimes, if that's the nature of your business, a lot of schools have June 30th year ends, right? It's the summer, everybody's off from school. We can regroup. So your balance sheet is whatever your fiscal year end is, if it's December 31st, it's only showing you the picture of the business on that date, what it looks like, right? As opposed to the income statement is for a period of time. And so you can mark off a month. Some of you are probably doing monthly income statements, right? Or, if you're going to have audited financial statements, have any of you even thought about having an audit, or has it been brought up? Yeah, stay away from that area. Okay, if you're going to go borrow money, a lot of the banks will require that you present audited financial statements, and now you're talking about a big expense. So if your books are real sloppy, it's going to cost you more money to get that audit done. So the cleaner your books are, if you ever need an audit, the cheaper and the more efficient and effective that audit will be. So your income statement then shows whether it's a monthly period, it's a period of time. It's a period statement, or whether a whole year or a quarter, okay? And then your statement of cash flows can be, it's also showing your cash position as of a certain period, right? It's going to reflect, this is the cash that came in during the year, and this is the cash that came out. And you're going to put it in, we're going to look at the categories that you put it in. Did you get your cash because you borrowed money, or did you get your cash because your customers finally paid you? Right? We're going to categorize what brought the cash in and where we spent it. Did we spend it to buy new assets? Did we do the day-to-day things, like we had to pay our employees, we have to pay our vendors, and so we're going to show the change in cash from period to period. So if you have never seen one of these, and this is a pretty simple one, right? We don't have to go look at anything. You probably have a lot of these. Now, the thing about a balance sheet is that it balances. This equation, maybe I can move this whiteboard real quick over here. Uh-oh. Let's see. probably like this. Does anybody know what the accounting equation is? Have you ever heard of that term before? I'll just put this here for a second because I want to show this to you, and it will help you understand the balance sheet. Okay, so now I'm blocking that. That wasn't too smart, was it? Let's scoot this just over here. Okay, so you see at the bottom there, it has total assets. So the sum of the total of the assets have to equal the other side of that balance sheet. Your assets have to equal your liabilities plus your stockholders' equity. Okay? And so there's my 187.6, and on that side, 187.6, and it's made up of these two pieces. So, sorry. So some of you, all of you have cash, some of you have receivables. Another asset would be inventory, okay? Maybe prepaid insurance. So an example of a prepaid that you would find on a balance sheet, if you had an insurance policy and you paid for a year in advance, right? They make you pay up front for it. So the definition of an asset is that it provides future economic benefits. So that insurance policy that you buy is providing you the benefit of insurance coverage for 1 year. So that actually is not an expense. It sits on your balance sheet, and then every month you're going to click off 1 month of expense. So if you had a $1,200 insurance policy, on January 1st it would be on your balance sheet as prepaid insurance of $1,200. At the end of January, the balance has dropped to $1,100 because 1 month has gone by, right? So that's how that works. And then, so receivables are good. Receivables are assets. That's what is owed to you. That's what your customers owe you, and that receivable amount will be converted to cash. So we will spend some time talking about receivables and their importance and how to manage them. And then on the other side, anytime you see a liability, you got that word payable up there. That means you owe somebody. Okay, so that's all the types of things. Accounts payable means you owe vendors. An accounts payable, just like an accounts receivable, is non-interest bearing. So if a customer comes to you and asks, you sell something to them or you're providing a service, it's understood that you can provide that service, and accounts receivable means you will generally give them 30 days to pay you without interest. Some businesses, you probably don't want to extend them more credit than that unless you're going to charge interest. On the flip side of that, accounts payable means you've bought something from a vendor and they usually reciprocate and give you 30 days to pay them, okay, without interest. When you see the word note payable, that's a loan. And that means that has interest associated with it, okay? And then some of you don't have stock. You would just have what we call owner's equity, okay? Anybody have stock? Nobody has stock, okay. So as you expand, you could actually sell or create, you could, have shares of stock that you can give to investors, okay? So, and common stock means, they are stockholders, they have an ownership in the business. All right, so that's what your balance sheet looks like. Now, here's a very simple income statement. Notice it's for the month of January, the current year. So all an income statement does is take all your revenues, we'll talk about revenues, and subtract all your expenses, and that bottom line is called net income. That's all net income means. It's all your revenues minus all of your expenses. And there's different ways of presenting that. So notice our sales, we're breaking them down between those sales that are on a cash basis, right? Just right away, you collected your cash. On credit means the other side of that would be sitting out there in accounts receivable, okay? And then your expenses, cost of goods sold is an expense that only applies to a business that has inventory. So for example, if I were selling this chair, and I bought that chair for $50 and I turned around and sold it for $75, the $75 would be my sale and then the 50 would be my cost of sale. And the difference between sales and cost of sales, we don't show it on here, but on some income statements you would present that as gross profit. Okay, so gross profit then is only going to apply to those businesses that are selling a product. If you're a service business, you're just going to have your revenues minus all the various expenses. So, sorry, that 70 should have gone over there. I hate when Word or Excel messes you up. There's just various expenses. And so these are expenses paid in cash. We're going to talk about something called accrual. Has anyone ever heard of that word? A-C-C-R-U-A-L, not cruel, but it is cruel. Accrual. And that has to do with cash as well. Accounting, you need to keep your books on the accrual method. That's what's accepted in the business world. Okay, I mean, you can start out small and use cash basis for a while, but as you expand, you want to move to the accrual basis. So what that means is you recognize revenue when it is earned. And earned means when you've either provided the service or provided the inventory, you handed over the inventory. It doesn't mean when you collect from the customer. So let's say that I'm doing taxes and you come in and I do your tax return. So I've performed my service, right? I've earned it, but I'm going to wait till next week to bill you. I'm under accrual accounting. I record that revenue today when I hand you the tax return, not when I collect the cash from you. That's how revenue is recorded. Okay, so that's the difference. If I were a cash basis taxpayer or a business, I would wait until I received the cash to record the revenue. But you want to, as you grow, you want to move away from that. You want to get to be on the accrual basis. Okay.
Does a bank recognize accrual?
They require. I mean, to have an audit, you would have to be on an accrual basis to even have an audit. That's what I'm saying. So as you get bigger, just kind of keep that in your sights that you may have to make that adjustment. See, when you file your tax return, you can do that on a cash basis. You have to declare on your tax return whether you're accrual basis or cash basis. But for audits, you don't have that option. You've got to be full accrual if you're going to have a real audit. So expenses, though, the way they work, expenses are recorded on a full accrual basis when the expense has been incurred rather than when you paid. Yeah. So if I go out there, let's say I've got an account at Home Depot, and I go over there and I buy some supplies, and I've got a good credit relationship with them. So I walk out of the store holding the goods, and they're going to bill me later. I mean, most people are using a credit card, but the point is, at the time that I purchase those supplies, that's when I record it. I don't wait till I pay for them. So that has to do with salaries too. So if somebody works for you and you're paying them every week, and if Friday happens to, and you pay them every Monday. If Friday is the end of the month, but you're not going to pay them till Monday, you still have salary expense that you need to record on your books. You don't record the expense when you write them the paycheck. You record the expense when they've earned it, right? They've worked 5 days, so you owe them. So you would have salary expense on your income statement, and on your balance sheet you would have wages payable. You would have a liability until you pay them. So that's what accrual accounting is all about, all right? And that's, this one I just put in parentheses, those expenses were paid in cash. But not all expenses are paid in cash. Okay. Here's a cash flow statement. So this is, it's funny because I'll go out and meet with a client and they always have a balance sheet, and they always have an income statement, and they go, we just don't do those cash flow statements. They're too hard to do. They're really not that hard, but they are so important, okay? So what this cash flow statement is doing, all cash flow statements are broken down into 3 types of activities. You have what we call operating activities. This is the cash that you receive or pay just in the normal day-to-day business operations. So you collect on accounts receivable, you purchase insurance, you pay your employees. Okay, they're just what we call operating activities. and it always starts, the method that we're using is called the indirect method. We take a net income number, and I want to point this out. When you look at an income statement and you see net income at the bottom, so if we go back to this slide, I don't know why there's a delay. I'm going to go back. Okay. Oh, so that $44,600 is not a cash number. That's not what was left over and put in the bank. That is just the difference between revenues. Notice how much of your revenues were in cash. 150 were, not all of them. A small amount was on credit. And so I just want to make you aware of that. So going back to this, you start with your net income, which is a non-cash number. And you take that and you do these adjustments. And we're not going to go through the mechanics of doing this, but what you're trying to do is say, from my day-to-day investing activities, I have net cash used. That means my cash inflows were less than my cash outflows. That's why I have brackets around it. You see? So my day-to-day operations, I paid out more cash than I took in. My other category is called, my next category is called investing activities. These are activities that are used, the main ones are to either purchase equipment or dispose of it. Okay, so look at the logic here. Cash paid for equipment, I need brackets around it. Anything that has brackets is a cash outflow. Anything that doesn't have brackets is cash is coming in. So if I buy equipment, that's an outflow. Now, what if I have some old computers or a vehicle that I want to sell? If that occurred during the period, that would also be an investing activity, but it will generate cash because when you sell it, hopefully you're getting some amount of cash in, right? And the other investing activities that some businesses will have would be investments in stocks. Okay, so as you buy and sell stocks or bonds or securities, when you buy them, it's an outflow. You got to pay cash for them. And when you sell them, it would be a cash inflow. And then probably most small businesses will have something going on in the financing activity section. This is where you borrow money, okay? You're financing your business. So look at the words, cash proceeds from short-term borrowing. That means during that period, during that current year, 12-month period, you took in from borrowing $250, okay? And if you made payments on that loan, that would be cash outflow. You would say payments on debt or payments on the loan. Okay, so this is a pretty simple one. Now, if you take the operating number of 650 negative, net cash used for investing, another negative, so you add those two up and you've got 1,000, and then you take the third category of financing of 250, the net amount that your cash decreased by during the year was 750. Okay, so remember that balance sheet. If you have a balance sheet on January 1st and you have a balance sheet on December 31st, that year span, your cash decreased by $750. You always need to know whether your cash increased or decreased, and you need to know where it came from and where it went to. And that's what that statement is doing. Okay, anybody? So you can see, okay, you see that cash balance on January 1st of $4,000? That would be sitting on your balance sheet. And then at the beginning of the year, and at the end of the year, your cash balance is down. It's down to $3,250. Any questions on that? I know I talk fast and I go fast, so please interrupt me.
I'm curious about the accrual method. It seems like it's not a true picture. What if somebody takes forever to get paid? They're either not working on the vendor or aren't paying them.
Well, that's why we have this cash flow statement, and that's why we're going to talk about doing cash projections and always being on top of your cash flows. You have to be predicting at least 3 months in advance how much cash is going to be coming into your business and going out, because you're exactly right. You're going, well, I've got a great product here. I'm always making sales, but are people paying you? And I see that's the biggest problem, is collecting on the receivables. A funny story, just yesterday, I have a client who builds dormitories. And after he builds them, he manages the property in-house. This is in downtown Dallas. And he used a business that is all about getting his taxes reduced. Not his income taxes, his property taxes. It's a property tax abatement business. And he used them for 5 years, and he got so busy, the guy never billed him for 5 years. Now, isn't that ridiculous? So he gets this email from him and says, oh, hey, we've been auditing our books, and we realize that we've never sent you a bill for all the work that we have done from 2015 all the way through 2019. It's 5 years worth. And so he sends his bill for over $13,000. And my client about had a heart attack. He goes, oh, we don't have the cash right now to pay him all $13,000. So we're going to talk about that. What can you do if you're in that situation? You've got some bargaining power. So think about it. If you were in his shoes, not my client, but the guy who didn't bill, you want to get something out of it. So do you just want to tell the guy, well, forget it, I'm going to sue you? Well, no, not for $13,000. It would cost you too much money to sue and wrap up time. You can work with them. So he's letting him pay $2,500 a month till it's paid off. Because now he knows he's going to at least get that much cash, $2,500 until he pays off that $13,000. Okay? Isn't that crazy? And then he sends this other email that says, LOL, I was wondering why my bank account was so light. And so we were kind of laughing at his accounting group. So hopefully you all are billing immediately. Don't wait 5 years to build. I can't make this stuff up. And this is a business in McKinney. 5 years. He somehow forgot to bill this guy. I just find that mind-boggling. Well, yeah. I mean, I'm counting every nickel and dime, and I guess he thinks, oh, I don't really need that $13,000. So he just did that. That's interest-free money out there. Crazy stuff. Okay, so our statement of cash flows, we want to focus on that. And once again, it's useful because you're breaking your business down into those 3 pieces. What's happening with your day-to-day operations? Some businesses, their day-to-day operations are taking all their cash out of them or away from them, and so they're having to continually borrow, right, to pay bills and stuff. You want to get to the point that your business, on that cash flow statement, on the operating activities, that's a positive number. Okay? I mean, every now and then you're going to have a little hiccup along the way where that particular period you used more cash than you took in, but over time, your goal should be to make your operations sustain your business, that you don't have to borrow. Okay? Okay, so there's our 3 categories: operating, investing, and financing. And this was what I was mentioning about the accrual. Operating cash flows differ from net income. So if you've only been preparing an income statement and you go, oh, happy day, I have a positive number, I have net income, it might not mean that you have positive cash flows. And I'm going to show you how that works. And you'll say, wow, I didn't think that could happen so quickly. So here it is. Negative cash flows, could this happen to me? So you've got $50,000 in the bank, you're doing great. Your monthly sales are $100,000, wonderful. Your monthly spending is $75,000, so what are you thinking? I've got $25,000 that I'm going to put in the bank, right? Theoretically, is that the correct answer? Well, what is the ending cash? It depends on how much of that $100,000 was collected. Okay, so let's assume that only $10,000 was collected, right? So you start with 50, you collect only 10, so now you're up to 60, and you spent 75. Now you got the brackets around the number. Now you got negative cash flows. Happens in the blink of an eye. Okay, it's all about the importance of those accounts receivable. Do y'all feel like you're managing your receivables well? Good. I had a big client. Their annual sales were 100 million. Okay, I mean that's in the public company world, that's not big, but this was a private company. And the owner's stepmother, after she retired, became the collection person for them. So when I first went out there and looked at their balance sheet, they only had $5,000 in the allowance for doubtful accounts. That's the number of your receivables that you think you won't collect. And I'm thinking, 100 million in sales and only 5,000 is uncollectible? They must be missing zeros. And as I got to know them and we did the audit, we found out his stepmother was the key to the only 5,000 uncollectible accounts because she hounded the customers to death, right? On the front end, she made sure that everybody had good credit scores. Don't sell to deadbeat customers, right? Everybody you sell to, there's a risk that they're not going to pay you, and you know that. So that's an important part of your business that you want to get a handle on. And because at some point in time, we're going to talk about you're going to have to write off some of those receivables, all right? Some of them become uncollectible, and we'll talk about how to manage that. Okay, so how do you make these cash flow mistakes? Anybody over forecast their sales? Those of you that have been in business a couple of years, you were overly optimistic. Okay, so my accounting personality, I always go light on the revenue side, right? I'm gloom and doom here. I'm going to say, all right, I'm going to forecast lower number for my sales, and then I'm going to overestimate on my expenses. I mean, not drastically. You want to be as accurate as you can. You want to be conservative. So I've seen businesses, they had a good month, and they take that 1 month and they use it to project for the next year. And you know better if that's accurate because probably you all have cyclical things going on, right? So you just can't take one good month and say that's going to happen every month. You have to look at, each month or whatever your pattern is. Now, I think the second one is the most important one and the one that people hate to do. Failure to track expenses. I'm talking about every expense, okay? I mean, you say, well, I went to the bank. Let's say I took out $500 in cash, right? And so that's out of your bank. And then you don't keep good notes on what that cash was spent on, right? It's in your pocket, it burns a hole in your pocket, and then you don't report where it went to. Any of you do that? Get cash out, and then at the end of the month, you've got only $20, and you're scratching your head saying, well, where did the other $480 go? So whether you keep a little paper diary or what, it's what you enter it in Excel, just take the time to do that. You will be shocked to see what you're spending your money on. So start tracking everything. And maybe, if you can get help with that. I know, if you're the owner of the business, that's the last thing you want to do. Yes, ma'am.
So do you have a recommendation, and I don't know how many other in here are like service-based. So I have like a fee for what I provide you, right? Like event planning or event
Right.
planning. But for each client, that might be 3 meetings, 4 meetings. I might be traveling to Frisco, to Dallas, to all over. So I'm very good about tracking my receipts for coffee and dinners. And
that's what I mean.
I am. I really, that's about it. But what about the time? What about is there a recommendation that you would say? Does anybody else feel that way? Like after the event's over, you feel like everything went well, but you're like, man, I worked 60 hours.
Right. Okay. So what that boils down to is, since you've tracked it, you should have certain standards. So this event generally should take, I don't know, so many hours. And so as you see that evolve and kind of get a standard, there's something out there in accounting called standard costs. How much time should it take? You're always going to have overages, or you have another one that went extremely well and you don't. And so that needs to be factored into your billing scale. Because you can't, probably in your business, you can't go back after the fact and say, oh, it took me longer than I thought, and so you owe me another $200 or something. You can't, you can't. But so in our business, when a client comes up to us and says, will you audit our books? And so we kind of talk through it and get a feel for what's going to be involved. And we have in our engagement letter or our contract, we said that, this is kind of reasonable and customary should we encounter, there's standard wording, difficulties or whatever, there could be additional billing. And that's kind of a slippery slope if you want to go there.
I own an event venue, and it's in our contract that this is your party starts at this time and it ends at this time. If anybody is still in the venue afterward, that could be.
Yeah. So like I said, it's kind of slippery slope, but if you find that you're getting more hours than you thought, like way more, then you may have to revisit your pricing on that. Yeah, because you don't want, try to break that down. What are you taking home per hour? Like my husband.
I don't know. It's different for every client. I know.
Yeah.
I don't know. I don't have a.
So in my accounting classes, I don't use Scantrons a whole lot. I make them do problems, which means I have to grade it. And my husband has joked with me all these years. He said, you know how much your hourly rate is? Because if I give an exam that I have 66 students in my class and it has taken me 8 hours to grade, yeah, my hourly rate is about $5 an hour. So you don't want to box yourself into that. Yeah, you'll never get ahead then. And you'll get burned out and whatever. So try to, yeah, I don't, if anybody has, you all have, some of you are already on top of that. Yes, ma'am.
I've created a range.
Yeah.
And then I kind of come in like towards the end and I say, hey, we're getting close to that maximum. So either we can cut it short or I'll bill them for additional hours before we even get to whatever that maximum was.
Yeah, because sometimes you do run.
Scope of work.
Yeah. You run into some unforeseen circumstances, and you kind of need to let your clients know that you might have to bill them for that if something it's not beyond your control, or something that they've done to make it not work. That's what we find with our clients. It's their fault that we can't finish the audit because they don't get us the documents we need. So all right. Uncontrolled growth. It's sad, the small business, while you're in that growth stage or that early stage, you're so hands-on, right? And then as you start to grow, then you lose a little bit of control. And so that's when things can go awry with your cash. You're not focused, because you're growing fast and you want that growth, but it comes with a cost. You've got to keep up with the cash demands from that growth. Lack of a rainy day fund. So hopefully you all have a rainy day fund. It's out there somewhere. And the rule of thumb is you really need 6 to 12 months of expenses in reserve. Now, if you have 3, I know you just made a look of horror. 6 to 12 months, because stuff happens, right?
Are those two separate things, or is that?
They're tied together. Yeah. The rainy day fund. So if you could look at your expenses and say, what should I have on hand? Like, what if you were in a business that was related to the weather or something? It was you needed some outdoor good weather, and it rained every day, or just all those different kinds of things. Or you got injured, right? You can't. You're on crutches for 2 weeks, or you can't drive for 2 weeks. So something like that. Okay, so tracking. We're going to talk about deposits first. And so I'm sure you're tracking your deposits. You look on your bank, you go to the bank, you take pictures. Deposits are so different now than when you actually had to fill out a deposit slip. And all my clients, they just take pictures of the deposit slip or whatever, and it gets deposited. So and the reason that you do that is if you're looking at your deposits are your cash inflows during the period, right? So if you're looking at that side of your bank statement, you go, wow, I took in $100,000 this month. Well, what if $90,000 was because you borrowed that? And the other 10 was just collecting from your receivables. You have to understand what those items on your bank statement really mean. What's the source of them? Have you ever had to kick in make some personal contributions to your business? I've not found any small businesses that the owner didn't from time to time. And you've probably been told this from day one, you got to keep that stuff separate, right? If you're a sole proprietor or whatever, you shouldn't mix your personal assets with your business assets. And that gets more important as you start, growing, and with your tax returns, and if you need it to borrow money. So the deposit thing, that's not going to take you long to do that. Now, these are some of your expenses. So, do you all do a forecast for these expenses on a monthly basis or further out? Do you look out there and say, I know how much I'm going to have to put out for supplies next month, payroll? You know your rent. Now, marketing is an interesting one. Okay, you got to be real careful with the money that you spend on marketing. Because I've known clients that will pay an ad agency or some type, there's so many different with all this social media. They'll pay 10 grand, let's say, for this marketing campaign. And when it's all said and done, they got 2 new customers who only generated $6,000 in revenue. So now they're in the hole. Now they have negative cash flows. Okay, so you want to monitor that. They're going to kind of bait you for that. Yeah, we can grow your business. We can, we'll get you this much more. Well, track it and see how much revenue it really did bring in, and then you might have to fire them. Okay, a lot of small businesses. What do you think your best source of marketing is, or what's worked for you? Has it been word of mouth for some of the small businesses? I mean, that's what I've found.
Social media.
So, yeah, social media. Yeah, so that's kind of like word of mouth. Yeah. So, but there's a lot of people out there that are looking to take your money with great promises of what they can do to increase your revenues. Your IT is always one that you need to, stuff is breaking all the time. That stuff's expensive to fix. So make sure you need to do a look back. Okay, I just met with somebody the other day who started getting into some negative cash flow issues. And I told this lady, I said, I want you to go back and I want you to track every dime that you have spent over this past year. And I want you to put it in the categories. I don't know, we had 50 or 60 categories. And she was really fighting me on it. She goes, oh, I can just look at my credit card statement. I said, well, do you run everything through your credit card? Well, no, not really. I said, well, what about the cash that you took out of the bank? Do you know where all that cash? Well, it wasn't that much. I got that answer. It wasn't that much. So when she finally dumped it all into a spreadsheet, she was astounded. And so then we took that idea. We said, okay, over the course of the year, this is how much you actually spent in cash on these items. Now, can you cut back any of these expenses? Going forward, budgeting, did you really need, now obviously like legal and stuff, but utilities, what options do you have for utilities? It's not a lot. Well, okay, so I have another client, turn it off. Turn off the lights, or I have clients that their office is real fancy with, they make sure they have their cable up and running and the fastest internet and all that, and so they have made cuts on that, and they're surprised sometimes they can save $100 a month. So if you go through several of your categories and you get 100 here and 50 there, you might end up with $1,000 before you know it.
In our event venue, it's like 6,500 square feet, so that's a lot to heat and cool, and especially in the winter. So I invested $1,600 in pull-down shades.
Wow.
Giant windows. You've been in our venue.
Yeah, they're great.
So we got these pull-down
Yeah.
shades that we keep down, and it's really.
And you've noticed a difference, the savings?
Yeah, it's helped a lot for our.
Also
AC bill.
the old buildings, if you'll put radiant barrier up there in the thing, I mean, I've seen things go from 900 down, you see it go down 50% in terms of the heating and cooling.
Yeah,
Simply,
it's historical buildings.
Yeah, or change, your building's fantastic, but, I can't imagine but the other thing is that, change electric providers.
I was going to say, you do have,
get ripped off all the time, you just
Yeah.
realize they're gouging.
yeah.
Check your providers, see which ones.
Yeah, and it's like the Spectrum versus AT&T. We just change all the time.
None of the above.
Yeah, okay, no, yeah. But watch the IT, the legal, watch who you go to for legal services as well, because they bill you for every phone call you make. So if you've never experienced that, they call you up and they're super friendly on the phone, and you get your bill and it's itemized, 10 minutes, and they those partners bill out about $500 an hour. So your 10-minute phone call can cost you close to $100.
And negotiate on rates. I just negotiated my rates with a really good attorney. They have special rates for little guys. So
Yeah.
she went back and got that done for me.
Yep. So track your expenses. So your cash flow forecast, a simple spreadsheet. I've got one that I can send to you. Okay. it didn't make sense to put it up here, but it's, you know, it's, you just drop in your beginning cash and you make a projection of what you think, and it's by month, and put what you think is going to come in and what you think is going to go out and see where you are. And then you have to start paring things back, right, if you have negative cash flows. Okay.
So your beginning
Oh.
cash would be, that's what you got in the bank, or what's your?
That's what you've got, yeah, it would be cash in bank, your balance, your beginning balance, yeah. So let's just talk about cost behavior for just a minute. Did you know costs have behavior problems? And you have some control with this because a variable cost is, it varies in total, but on a per unit basis, it's fixed. So if you were manufacturing something and let's say you needed a piece of plastic in manufacturing that, and the little piece of plastic is 10 cents per sheet. Okay, obviously, if you manufactured 1,000, your variable cost for that would be way more than if you manufactured just 100. So your total is changing, but in per unit, it's just 10 cents. So you have some control over your variable costs. Your fixed costs, though, they're fixed in total, but on a per unit basis, they vary. Now, what I mean by that is, if you're paying rent, in the short term, you've got a 12-month lease, right? And so you're stuck with that for 12 months. So what you want to do is make sure that you're utilizing that. If you're manufacturing something, if I spread $2,000 rent out over 10,000 units versus only 1,000 units, the more productive you are, the more bang for the buck you get from your fixed costs. So, and you got to be careful about fixed costs, okay? Because you can't get rid of them. You know, leases and things that you sign, their legal documents, you can't break them, right? So just understand that you've got that behavior out there. So where I'm going with this is, do you know how much service or how many units you need to sell to break even in a given period? Have you ever talked? Now, you don't just want to break even, but it's good to know what will it take for me to break even in any given month, okay? And so the way we do that, okay. So we have this is called cost volume profit analysis, and contribution margin is just the difference between your revenue and your variable costs, okay? So your variable costs, if I were, let's talk about a service that you're providing. So let's say you charge $200 an hour, right? And let's say the only variable cost in there is that your salary, you're taking out $150, okay? Or you're paying somebody. Let's say you have people working for you. And so you're charging your customer $200, but the person who's providing that service that is working for you, you have to pay them $150. So your margin on 1 hour of time or service is $50, right? That has to go to cover all those fixed costs that you have. So you're always trying to maximize your contribution margin, okay? And you can do it in total or you can do it on a per unit basis. And then operating income is the difference between that contribution margin and the fixed cost. So you always want to be aware of your ratio, your contribution margin ratio. Show you this. Can you all see? Great. So let's say that your revenue, let's say it's $100 an hour, okay, or for that service, whatever you're doing, and your variable, I'm going to abbreviate that, variable costs are 80. So your CM, your contribution margin, is $20 for that job, right? And so you would do a ratio, your contribution margin percentage, you want to be aware of that, and that's just going to be your contribution margin divided by your revenue. So in this case, you can see very simply that's 20 over 100. So your contribution margin, you're at 20%. What that means, for every job that you do, you are contributing 20 cents. For every dollar of revenue that you have, you're contributing 20 cents to cover your fixed cost. So you want this to be high, right? Because you got a lot of fixed costs. You don't want, and you know, some businesses make money on volume. And I'm sure some of you don't have a lot of volume, right? You have big dollars here, but you still have the fixed cost. Like grocery stores have terrible margins, contribution margins. They get their operating income based on the volume that they sell. But that's one thing you might want to track, okay, to see how much your direct costs, your variable costs that you control, and track that margin and see how much you're contributing to those fixed costs. So with that, we can, here's an example. Okay, so we've got Trendy's tables, and they sell for $600 each. The variable cost is $350, so that's the materials, right? And then the annual fixed costs are $20,000. If they sell 100 tables, what will the operating income be? Okay, so what you would do, the contribution margin, if we follow this example, would just be 600 minus 350, or 250, right? And so you would multiply 250 times 100, and you would have 25,000, and then you subtract the fixed cost. Okay, so you're left, your operating income is only 5,000. Does that kind of make sense? Probably need more time to digest that, but what you're trying to do, yeah. Okay, but see, okay, so here's the example. Let's make this even simpler. You went out there and you bought a table that you're going to sell. Maybe you customize it, maybe you put a logo, I don't know what you do to tables, but your product is unique, and so you paid $350 for it, and you're going to mark it up to $600 per unit. So your margin is $250 on each table you sell. Okay? So you multiply, so if you sell 100, it would just be $250 times 100, or 25,000. Okay? And then so you have 25,000, and you have to cover those fixed costs of 20. So your income then is only $500. Okay? But what? Or yeah, 5,000. Yeah. So but the fun thing is what we're going to look at next. You can figure out what your break-even point is.
Would you do me one favor, because some of these terms I'm really new to me, so I don't mean to be
No.
a dummy.
No, you're not a dummy.
Would you help me? I get that up there. I understand
Okay.
that equation. I totally get it. Got the algebra.
Okay.
Now, what I don't have are the terms.
Okay.
So I get the formula.
Right.
Fine, do it every day.
Right.
Now, help me what the terms are again, because
Okay.
these are accounting terms that I don't
Yes,
get.
ma'am. So the SP stands for selling price.
Got it?
Very simple. $600, right? Your VC, or your variable cost, that's what you paid for it. That's what you have in it.
Okay.
Okay?
got it.
VC, variable costs. And then the difference between the selling price and the variable cost is called contribution margin, CM. Okay, and so that difference is left to cover your fixed costs. That's your rent. That's your insurance. They're all the costs that, it doesn't matter whether you sell 1, 100, or none, you're still on the hook for those costs. Okay? So you want to work on maximizing your contribution margin. So I got the message here, it's the 2-minute warning, so I got to...
Can we send them the terms?
Yeah.
Yeah, well, it would really be wonderful to have a handout with all the terms.
Sure, I didn't know anybody would be...
That would really, really helpful.
So what I'm saying, the goal of this is to take these terms and calculate how much it's going to take you every month or year to break even. So if you have 6 clients, you might only need 6 clients to break even. You need to know that, right? Because if you only have 4 clients, there goes your negative cash flows. Okay? So I can get this stuff. Is that my? So this is just another way to find, it's the line on the bottom is the important line. To calculate break even, you just take FC, your fixed costs, and you divide it by whatever that contribution margin is per unit. So remember, our fixed costs were 20,000, and our contribution margin per unit was $250. So you only need to sell 80 tables to break even. So you can see why they were profitable, because they sold 100 tables. So you kind of always know where you are.
What does the Q stand for?
Quantity, yeah, no, sorry, yeah. The time just flies by.
It's so much fun.
Yes, it is. So yeah, there's, this is just a continuation of that. I think we're done. Okay, so you can even go beyond that. If you say, I want to make $500 or $5,000, there's a way to calculate that, and that will walk you through it. You can have profit goals, right? You just don't want to break even. You want to have $10,000 a month or whatever it is. Okay, so this is just kind of in summary. These are some things that you can do to increase your cash flows. Some of you might want to ask for a down payment or a retainer up front. Okay? Discounts. Any of you consider discounts to make your customers pay faster? It's like magic. It really does work. Okay, 210, yeah, another accounting thing. That means you get a 2% discount if they pay within 10 days. Otherwise, they got to pay you the balance in 30 days. I've seen people do different percentages, 1 in 20 days. I mean, that's not written in stone. You can do whatever you want, okay? Lease equipment. You might offer incentives to increase sales. Some of that's more of a marketing thing, okay? And these are things that, this is also important. What can you do to stop the bleeding, to decrease your cash outflows? Okay, so just like my client who got hit with that bill for 5 years, he requested, he negotiated. He asked for that barter. Any of you use barter? Like, you're good at this, I need your services, and I'll give you mine, and so there's no cash outflow from that, right? It keeps you from hiring somebody. Delay expenses. You can ask for favorable payment. Probably. Sell children. How many of you age your accounts receivable? This is an eye-opener. Anybody who owes you money, you need to drop them in a bucket as to how far past due they are. Okay? Because the further they get from current, not yet due, the more the likelihood is you're not going to collect.
Yep. Slowest pays are the big guys.
Yeah.
Slowest pays were the biggest corporations.
Yeah. And that, I see that all the time, so you're willing to work with them.
Yeah.
Because you have to.
Yeah, but you have no choice.
Right, but watch out. I mean, make sure you don't let that slip up and you let it creep into
Just
it.
increase your rates next time.
Yeah, yeah. So this shows you how you calculate, this is how you age your accounts, okay? And so your bad debt expense, it's a number that goes on your income statement, but it doesn't, it just slows down your cash. You said that of all your receivables there, you're not going to collect $4,661. Okay. Oh. Yeah. We're fighting over the, all right. So yeah, I admire you all so much. And I'll give you you can reach me at TWU. I'll have that information. We can get that to them, and feel free to contact me. I'd be happy to answer any questions.
Are you familiar with a cash system called First?
No, I'm not.
It's interesting. I read the book, and it's interesting. Instead of revenue minus expenses equals profit, it's revenue minus profit equals expenses. So it's almost like a cash envelope system, but use bank accounts and get, use your creativity to, reduce those expenses. But make sure that you're profitable first and foremost.
That's very good. Anybody else have anything? You just want to go home and do your shopping for Thanksgiving? That's where I'm going right now. So, yes, ma'am.
What is tell me again what a contribution
Margin is? It's your selling price. It's your whatever you charge for your service, your selling price, minus your variable costs.
Okay.
And that's your contribution margin. Okay? So thank you all and good luck.